strapped South Africans depend on credit cards to buy essentials, more so at this time of the year. The ever-rising prices for food, fuel, school fees, stagnant salaries, and an erratic economy leave many consumers with no other option but to resort to debt. Joining us now for this conversation is Economist Mudiwa Gavaza. Mudiwa, thank you so much for your time and for joining us. Now, Mudiwa, I've mentioned a number of factors, but what factors do you believe have really contributed to South Africans increasingly relying on credit cards to meet their financial needs on a month-to-month basis?
Well, good evening, Katlego. It's a very alarming, situation that we're in, and I say alarming, not because there's anything that we don't know, but the fact that we still have this set of circumstances all these years, all these years later, because what's happening right now is it's accumulation, of what had been a slow economy before we got into COVID-19. And then, the slowdown that happened during that period. And then now people, still suffering from the high interest rates and high inflation that we're dealing with right now. Prices are going up, basic goods are going up. So people are turning to things like your credit card as an immediate way to be able to deal with some of the more immediate needs that they have. And the reason why credit cards, stick out is simply because there's some data that came out earlier this week where the Reserve Bank was actually showing that other types of lending have slowed down. Think your mortgages and that type of thing. And usually that type of lending usually shows that there's expansion, people are growing, people are willing to invest, in things like homes and that type of thing. But when you see extensions when it comes to personal loans and credit cards, then it means we've slowed down the investment activity. We've sort of gone into a survival mode, and we're looking for ways to address the immediate needs. Big things that are happening right now, obviously higher interest rates, higher inflation, and obviously people trying to deal with the load shedding crisis. If you don't have power, what are you doing for food? How are you keeping the lights on at your house? These are all extra costs that South African consumers have had to deal with.
So, Mudiwa, speaking of that spike in credit cards, are banks comfortable to increase the credit card limits and to offer these credit card loans to consumers, especially during a time like this?
Well, on the whole, the Reserve Bank is actually reporting that, banks are a bit hawkish. And when we say hawkish, we mean tentative. It means they're being careful about extending, too much credit to households, because they already understand that household budgets are strained, balance sheets and homes are not where they're meant to be. So things like, your credit cards are usually a little bit easier, to extend. But, the other types of lending that we spoke about just now, there's a slowdown obviously in demand, but also the banks themselves are a little bit more careful in how they're extending that type of thing. So it does seem as if, everyone is on edge, when it comes to, the situation that we're in. Because at the end of the day, I want you to think about the fact that banks are in the business of lending. That's how they make money. So if you see them being a little bit conservative in how they're thinking about lending money to households, then you know that the situation is serious, because essentially they're saying we need to make money, but the risk, that lies, at the household level is a bit too much for us right now, to be freely, extending credit the way that we would normally want to.
Well, certainly. So how would you then, Mudiwa, assess the impact of this trend on the overall financial well-being of South Africans?
Well, there's a couple of things to consider. And the first one is the fact that unfortunately this feeds into, a narrative, an unfortunate narrative that has existed in South Africa for a number of years. And that has to do with over-indebtedness. South Africa has had the infamy of being a country of spenders as opposed to savers. And a lot of that spending has been supported by, credit. In terms of lending, both on the formal side and also on the informal side. Think your loan sharks and that type of thing. And this unfortunately continues to dig that particular hole, because in any country we should be trying to get the savings rate to increase, because if you have a savings rate that is high, essentially what that allows you to do, just taking it back to some economics 101, is that if you have a country where people are saving a lot of money, then it means that you have banks and lenders that have even more funds to lend out for investment activity, roads, schools, hospitals, businesses, that type of thing. So the rate of savings in a country usually tells us, quite a bit, about the health of the economy, because at the end of the day, an economy is made up of each individual, person in that economy. So if at the household level we are not healthy, then it's not too far of a stretch to say that, the health of the economy itself should be a concern.
I mean, you speak of possibly increasing the savings rate, but what has increased is the national minimum wage from 25 rands and 42 cents to 27 rands and 58 cents. Could there be a direct correlation in this increase on what the impact would then be on consumers if they have to pay, for instance, a household needs to then increase what the domestic worker would need to be earning?
Yes, to some extent, I would say, that does feed into it, because, it does mean that, some of the spending increases, right? And also on the other side of that scale, depending on the health of the household, some of those increases may actually lead some households to say that this is the type of spending that they don't want to, engage in. If a certain minimum wage is outside of a household's budget, then it possibly means that that is a job lost, for a certain individual who would have been servicing that particular household. So it has, these some of these knock-on effects. The other thing to also then think about is, if you are increasing, some of these things, the economy, works in a cyclical manner, and by that we mean, one, set of costs, it tends to affect another cost, another cost, another cost. And those are some of the things that might be working them, their ways into some of the price increases that we're seeing in other goods and services. If you increase a minimum wage on one side, then it means if it's part of a process that has, for example, bread arriving and being at your house, then it's very possible for a producer, to then pass on some of those cumulative costs, to the consumer, and thereby we continue having this virtuous cycle, which feeds into the inflation narrative that we were talking about just now.
So if we are to hone into some of the demographics, are there any specific demographic groups that are more likely to turn to credit cards as a means of getting by?
Well, one of the things that we have to then think about is the fact that in a lot of instances, for a person, we have to think about I'm going to call it the KYC. Banks usually have something called KYC, or Know Your Customer. There are usually some requirements that people have to go through in order to be able to have, some type of credit, especially things like your credit cards. And one of the key things is having a reliable source of income, right? Because most of the time, whatever credit is being extended to you is a function of how much money you have. So before we even go anywhere, we're looking, primarily at people that are taxpayers. You're looking at people that are more likely, to be in the middle class category, and then also at the same time, people that likely have other credit products as well, because banks need to be able to assess your ability to service a certain loan or a certain debt. However, I will say that things like credit cards, on the totem pole, are probably one of the, especially for professionals, are probably one of the things that a person has access to, it's one of the more accessible forms of credit. A bank would likely, extend a credit card before they can extend to you a home loan, a car loan, or something like that.
Speaking of that, I mean, are there any governmental or regulatory interventions that can be implemented to discourage excessive credit card usage, not possibly for that middle class group that you speak of, but those that certainly wouldn't be able to service that credit card, or it could get them into that revolving cycle of credit for a longer period as opposed to those in the middle class?
Well, that one is a very tough one, and I say a tough one, simply because you're dealing with a situation where people have constrained incomes, right? And that's the main reason, why we're saying we are seeing, this extension of personal loans, unsecured loans, as well as, your credit cards, right? So you could be government, you could even be a financial planner, for example, and say to someone, hey, please don't be using this thing. But if, let's say, you are getting a lot of people, complain about the fact that, there's, too much month that their money has to account for. A lot of people by about the 15th of the month, if they get paid on the 25th or the 30th, are already complaining. Right, and we've seen the fact that informal loans, loan sharks, that's a huge market, and it's not a mistake that that's a huge market. Budgets have been constrained for a long time, but now it's even more so. So at the base, we would need to either have incomes, in aggregate increasing so that people can be able, to meet their basic needs without turning to credit, or the reverse happening where you have a decrease in some of the expenses. Everyone is complaining about inflation, for example. So you either increase incomes in the aggregate, or you reduce costs, in the aggregate. But as things stand, I think it's a tough one. We would want people, not to be abusing, some of those facilities, because, abuse, might lead people into situations where you then have bad credit. You can't service these things. And then down the line, it means that you can't get, a home loan and things that you actually need. But what is a person meant to do? There's very tough decisions that people are making out there. I remember a couple of months ago, we engaged with the meat industry, and they were, talking about the fact that a lot of South African consumers, for example, had been substituting themselves out of beef. Simple basic thing like eating beef and switching that over to eat pork or chicken because it's a cheaper source of protein, right? So on a very basic level, these are some of the manifestations that are taking place when we say that consumers are under pressure.
Well, certainly those alternatives would make a big difference. And I think my question then would be, how would you then classify a healthy relationship with your credit card? When would you classify it as being toxic?
It becomes toxic where you aren't able to, service, that amount. And when I say service that amount, we're talking about the fact that most of the time when you have a credit facility, you are able to, spend beyond what you have in a bank account, for example. It's an extra bit of cash. But if you then find yourself, let's say, it's around the 15th, there's no more money in the account, you turn to your credit card and you start spending, spending it as such. Then maybe on the 25th, you get paid. One of the, best things that a person could do for themselves is either on that day or on the recommended days. Banks usually give recommendation as to how much should be paid when. If you find yourself not even being able to pay those basic amounts, if you're that stretched, then it's probably, something that's not for you. A second danger that then arises is, becoming too used to, a facility like that. Because the other danger is that apart from the fact that you have to pay back the money, is the fact that there's interest that is accumulating, which means you're no longer just paying back what you spent, but you're paying back that plus more. We call it interest, but in essence, it's a fee on the amount of money that you would have spent that is not yours. So if you're not careful, you then get into a cycle where you try to service the credit card, but you just don't have enough money. Maybe your money was taking you onto the 15th, then you'd get onto the credit card. But now maybe your money is only taking you because you're now repaying the amounts. You have less money on payday immediately. You're paying back. Now maybe your money is running out on the 14th, the 12th, and so on. So it's a very dangerous cycle, to get into. I don't want to sound alarmist. It's just that, fortunately or unfortunately, things are constrained, but, some measure of discipline does need to be extended.
It most certainly does. I mean, you mentioned earlier on that COVID-19 has played a significant role in the increase of South Africans using credit cards. Can we predict as to when South Africans could possibly see some light at the end of this tunnel? When do we see South Africans having some reprieve in them not having to depend so much on credit cards in the near future?
Well, for now, we just turn to the macro picture, and by macro picture, we turn to the national, because one of the big debates that's out there is that the South African economy just needs to grow, much more than what it is right now, because that then feeds into increasing productivity, increasing investment, and probably creating more jobs, and all that getting into a cycle where hopefully people can then, rely less on some of those products, especially on the more informal side. That's one of the big reasons why we keep, drumming on about the fact that the South African economy does need to grow. The good news for now is the fact that expectations are that South Africa's economy is slated to grow in 2024, albeit at a slower rate than many would want. But at this point, any growth is better than no growth. At the end of last year, the IMF had pegged South Africa's growth for 2024 at around 1.8%. Unfortunately, there's been a revision this week, up by about half that, where the expectation now is that the economy will grow by about 1%, for the year. So it's the growth, and we just hope that growth does come through and it starts, addressing some of these issues. Second thing is also about the fact that there is an expectation that we are likely to see interest rates coming down. People are hoping that in the second half of this year, we will see interest rates starting to come down. That has the effect of, helping people, that have, loans of some sort, whether it's a mortgage, a car loan, that type of thing, credit cards, even fall into this, and the fees that are being charged, as interest, it all feeds into that narrative. If the interest rates are coming down, then it means the costs on all of these things are coming down. That's good on a household level. It also means that, borrowing costs for businesses as well also start to come down, and you hope that some of those benefits then get passed on, on a household level. So the big things that people are looking out for is growth, is, starting to lower of interest rates. We're not sure, how that's actually going to materialize. And then thirdly, coming down of prices.
Well, Mudiwa, certainly giving us hope and light at the end of that tunnel. But until then, South Africans most certainly still need to tighten those belts. Thank you so much for your time.